right. So just now, right, when I was looking at all the crowd over there, I see that all the heads were like coming down. I know, right, it's like 3:20, very tired, whole day here. So let's get some exercises here together, right? So what I want you to do is that to do this. Can? But not yet, not yet, not yet. I'm going to ask the questions first, right? Who here have not invested in ETFs? Have not, belum invest, tak pernah invest. Wow, so majority are ETF investors. We have a few here, okay, right. So I hope that at the end of today's session, right, we have everybody here invested, right, guys? So that's our aim today, okay? So with that, right, my first question for the panel today is that to Mr. Kinon, right? So just quickly explain to us, right, what are ETFs and why ETF is such a good instrument in your opinion, if it is a good instrument to actually invest in the global markets?
I'll break down these questions in two parts. I think number one, which is a lot of investors may confuse between UT and ETF. So there's no distinct difference between UT and ETF. The only difference between UT and ETF is just the trading infrastructure. How the buy-sell between UT and ETF set the difference between these two sort of product, right? Principally, you are giving a sum of money to fund managers, which the previous sessions, some of the fund managers on stage. So you're literally giving them a fund, which you both agreed principally in terms of the investment strategy, and that is about it, the investment. So differences between UT and ETF is just the trading infrastructure. So, and the second part, because of the trading infrastructure is different, ETF are exchange listed. So technically, me in Malaysia, whether me in Indonesia, anybody in, even in Thailand, as long as they have a brokers like FSMOne, which allow you to gain access to, for example, US exchange, London Stock Exchange, Hong Kong, Singapore Stock Exchange, and technically you can buy funds that are exchange listed or traded on that particular exchange. So building a global exchange or exposure really require that trading infrastructure to be in place. Like for example, in UT, in Malaysia, you require individual funds to be set up. That means that a lot of manual and paperwork will happen. As compared to ETF, it's just exchange listed. As well as today, we added one ETF on the exchange. On the next day, investors can see.
Right.
But you know, it has to be, the investor has to have access to that exchange first.
So if I understand correctly here, it's that, so basically ETFs are actually stocks, right? They are listed on the stock exchange, right? And there are different stock exchanges. Even on our platform, we have these various stocks exchanges, right? On LSE, on US, Bursa, Singapore, and whatnot. So what's the difference then between the ETFs? Are there any? Any differences between like ETFs listed on LSE, on US, on Singapore?
There is. Principally, there's no difference in terms of how ETF works in respective exchanges in respective country. You are literally assigning your fund, giving your fund to a fund manager to manage on behalf, to generate a return which both of you agreed upon on the investment mandate, right?
Right.
So that's the foundation. So what sets the difference is that product innovation, right? US, everybody knows about Wolf of Wall Street. And they all started investment way back then. They have been through so much as compared to the emerging market or the Asia market like Malaysia or closer to a country is Singapore, right? In US, there are over 3,000 over ETF. For context, Malaysia, I think the whole Asia combined may not have over 3,000 ETF. So that really set the difference because US has started off way early, right? In terms of investment industry, wealth management, they started way early, right? So product innovation and economy of scale. What do I mean by that is that one unique point in, for example, private equities, private debt. You know, just by name of it, every investors or everybody will sort of be worried, right? Because it's private, right? It's Sanjuan Bahat, right? But private equities and private debt is very matured in the US market. And famous fund houses like PIMCO, Apollo, they invest in private equities and private debt. So these private debts consistently, I think, if I'm not mistaken, annualized returns is about more than 10%, right? So, because to summarize the answer is that US and other regions have started off the investment advancement earlier. Product innovation and economy of scale has makes a difference between
Right.
ETF in the local versus in US.
On in the US. So here it's that like, if I understand correctly, right, it's that different ETFs on different markets, then there are different strategies that you can actually make use of to invest that, right? But just to move on to Sean, right, like you actually look at clients' portfolio, and also by the way, guys, it's that CIS services are free, and if you have any investment questions, feel free to actually drop in an email or give a call to the CIS. And on that, right, Sean, when you're looking at client portfolios, right? What is the common kind of a behavior that you actually see inside clients that invest in ETFs?
Okay, if we look at the real portfolio of our client, right, I will notice that normally the real client actually they tend to over investing, meaning to say for the ETF that you put in into the regular saving plan, normally I will see the list is very long list. Maybe it could be more than 10 or even more than 20 ETF.
So that's an
this
ETF
is,
collector.
yes, ETF collector. So they buy everything. So they think that yeah, if I buy everything, then I will get all the exposure and I will get all the return. But in fact, actually, this is not the way for you to invest in ETF.
Because, and why so? Why do you say that it's not the way? And
Okay, because for my philosophy, when you invest in ETF, the less actually is better. Why? Because if you overly, this is a term that we call overly diversified. If you hold too many ETF funds, you are not able to understand which are the, you thought you are diversified, but in fact you are not. Because diversification means if the market drop, then all the holding or ETF under your portfolio will act differently. If the market drop, all your ETF are dropped at the same time, which means you are not diversified, which means actually you are duplicate, you are having a lot of duplication of the same company.
right. Thanks, Sean, and thanks, Kinon. But before I grill the panelists on your questions, right, could we have the Slido code for a while? Because we can also welcome questions from you that you have on ETFs. It's here. I can actually log in, and I can have the questions, and I'll be asking on behalf. While I ask the next, could we have the QR code? And you can actually, or if you're already logged in just now, you can ask in the same one, right? So, Kinon, to you just now. Sean said that you shouldn't be too diversified. 10 is too much, right? So let's take a ballpark number of 3. So if given a choice, right, what will be your 3 set and forget, just give it there, let it run, and like a retirement ETF that you'll pick, and why?
I wouldn't call it a retirement
Okay,
plan.
still a long way, huh?
But I would say probably these tickers that, or maybe these sectors or strategies that I think will generally suitable for a lot of investors. So break them down into 3 parts. First, which is the core. Second, which is the stabilizer. So, and the third one, which is thematic or growth.
So it's core,
Stabilizer,
stabilizer,
thematic, and growth.
thematic, and growth.
Yeah. So the first one, core, investors can even consider, FTSE Russell over index. You know, there are a lot of fund managers are issuing this ETF, right? In terms of the stabilizer, I think can look at global aggregate bond. That means that a single, let's talk about single currency bond fund. You are very much exposed to the US dollar interest rate risk, right? Any movement in the dollar interest rate expectation will result in a bond price being up and down, right? But if you invest in the global bond index, so that will provide you a much diversified in terms of interest rate risk. And the last one, which is the thematic and growth. For example, everyone talk about AI now, right? So if you want a little bit of growth or AI into your portfolio, so make that up into the portfolio. So in terms of weightage, I think that really very much depending on where the economy is heading. And individual investors' risk profile.
All right, because like when you're explaining, right, Kinon, I saw a question here is that so many different ETFs, even you mentioned, right, 3,000, which one to choose, right? And you actually exactly summarize it, three ways, core, thematic, and strategic stabilizer. This will be a good start for it, right? And also to add on that to Sean, right, from investors' perspective and behavior, and in particular when we talk about dividends and distributing ETFs. So what's the difference then between the London UCITS and the one in US?
Okay. Generally for US ETF, right, they are distributing out their dividends. So meaning to say, you will get the dividend payout back to your cash account in FSMOne. Whereas when you invest in London Stock Exchange, there are certain classes, actually it's the accumulating classes. So when you invest into accumulating classes ETF, the fund manager will help you to reinvest your dividends. So by performing the dividend reinvest back in the accumulating ETF, you are able to compound the dividend returns. So if you compare the return of the US ETF with distribution, together with the LSE ETF with accumulating, the accumulating will tend to have slightly higher return if you compare into the same index.
Right. And when you talk about this on the tax perspective, right? So on Kinon's side, like, are they similar with those in Hong Kong and also in Singapore? And let's say, right, investors, okay, Singapore is famously known as a dividend play market, right? So if I want to be invested and I want to get dividends from that, what also will be the tax impact?
Because talking about Singapore, right?
Singapore and also in Hong Kong.
Yeah, because in Singapore, one of the uniqueness about Singapore is that everyone is a small island. Hopefully, there's no Singaporean here, right? It's a small island.
Our next speaker is.
Oh, sorry. So it's a small island. So what happened is that property prices is high. I'm sure maybe some of our family members is working in Singapore may be looking at rental being double, right? Pre-COVID, post-COVID being double. So the uniqueness about Singapore is that something which is called REITs, right? And ETF, we also have a class in ETF that invests specifically in REITs. So REITs are consistently giving 5 to 6% income distribution from this ETF. So as a replacement, instead of looking for bonds in the SGD place, or maybe fixed D in a local bank for SGD, ETF will give you that higher return in the SGD, in the Sing dollar perspective. And REITs, for example, Pavilion, just imagine how REITs works is that in Pavilion, you have a lot of store, right? You have a lot of shops and all that. So REITs collect rental from each respective shops and store. And typically all these shops, they are very sticky for 1 or 2 years. Those are contract. But you have even seen Pavilion KL, those shop doesn't change.
Yeah.
Right? LV is there, Dior, Chanel, they don't change. The store is there, restaurant is there. So what I'm trying to say is they are consistently receiving rental from these people who rent, these businesses who rent a shop or a place from that REITs. So REITs will consistently receiving income. And on the other hand, one thing about REITs is that REITs have to distribute 90% of their revenue so that they are not subjected to a standard corporate tax.
Right.
So that's the unique things about REITs. So in Singapore, it's particularly high return because of the nature of Singapore.
On the country itself, right?
Yep.
And so here it's that this is an additional function and feature of ETF itself, where instead of going also to REITs, if you want to have a basket of REITs, then like what Kinon said is that those REIT ETFs that's listed on the Singapore markets will be a good option for investors to get consistent dividends there, right? And also, Sean, from morning, right, we have been hearing a lot of speakers from different market outlook and market perspective, right? So when you're actually investing in an ETF, when a broad market passive ETF, right, how will you actually advise clients on this with the market cycle? Does it matter? Do you need to constantly actually look at the markets when you're doing that?
Okay. to add it on the REITs, right? To be exact, if you buy the Singapore REITs right now, I think the return is around, the dividend payout is around 6.5%.
6.5.
Because the price is lower right now. Okay. And back to Bhushan's question. Okay. For ETF, if you are invested in a broad market index, for example, like S&P 500, which capture the top 500 company that listed in US. For my opinion, you do not really need to bother on monitor for the market because based on past 20 years returns, US S&P 500 index has a very constant upgoing trends for the market performance. So when market drop, actually that will be the golden time for you to buy for that particular index. Means you are able to buy in cheaper pricing, and then with cheaper pricing, you are able to get more unit in the sense. And then by doing this, when you invest in, besides when you invest in S&P 500, you do not need to really monitor the market or monitor the company that exists in this 500 company because the index itself, they will help you to naturally select the best company in putting them into the top 500 company. What happened is you just imagine, you just recall something like some company that very famous 20 years ago, Nokia. At that point of time, Nokia is the top 10s in S&P 500. But today, are you able to see Nokia in S&P 500? No, right? Because if the company is not able to go through with with the industry, they will be taken out from the S&P 500, which means you are constantly invest in the top 500 company in the world.
So I'll say that this is the survival of the fittest by natural selection. Means when you say S&P 500, it's always the best, right? So in the next round, right, we'll do a rapid fire round. I'll ask a question, a very quick one word or one sentence answer to that. Okay, you guys ready? Right, who wants to go first? No, I'll pick. Okay, to Kinon first. One myth Malaysians should stop believing about ETFs. A myth.
Collect asset class, don't collect ticker.
Wow. Wow, that one very quotable. Say that again.
Collect asset class, but not ticker.
Okay, collect asset class, not collect ticker. Very good one. Sean, one thing you must, accumulating or distributing ETFs. How do you decide?
Accumulating?
No further explanation.
I think I explained just now because
Okay.
accumulating will help you to accumulate the dividend reinvested, and then you will be getting more return because of the dividend start compounding.
Okay, also again to you, right? How frequently should investors balance their ETF portfolio?
Okay, I will answer it. You give me some time. Okay, this one very important. How frequent should the customer balance their ETF? Okay, for me, if my life state never change, I won't change my portfolio either. So which means I just let the ETF to continue to grow. And then we just set up the regular saving plan and invest consistently. The keyword is consistently. You need to invest consistently. And then for the customer behavior, I think once a year, it should be good enough to review your ETF portfolio,
Okay.
but not to say to perform the rebalancing every time.
Right. And a tough one to both of you now. Unit trust or ETF?
Both.
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 That's it. No
Okay.
further.
Why? ETF is good for developed market. So if you would like to invest in US or Europe, then you go for ETF. But if you are investing in emerging market, for example, like what the panelists share or the fund houses speaker share just now, we don't want to invest in those emerging market like China, Asia, Malaysia, then unit trust will be the best tools to go
Last
for.
one. And when to, the very common question, right? Everybody gets this. When to buy and when to sell.
Okay, I go first. Okay, when to buy?
Okay.
Very simple. Once you set up the regular saving plan, means you set up the strategy of invest on monthly basis. then you do not need to figure out when to buy. The system will help you to buy on regular basis. You buy no matter the market up and down. So when to sell, very simple. When you accumulate the investment through regular saving plan, then you will have an accumulation of amount. So you only sell when you need the money.
Okay. So with that, the times we have done, right? Right. So thank you so much to our panelists, Mr. Sean and also Mr. Kinon. And just to wrap up, what they actually said is that ETF is actually a very powerful tool to globally diversify. Remember the three things that Kinon said. And it's not between a choice of this or that. It's this and that. Means that UT and also unit trust, we need to know the tools properly that we're using and use the tool accordingly to our objective and investments. Right? So thank you so much.
Can I have one more tips for our
Oh,
investor over
bonus
here?
tips, all
Okay,
right.
one more tips. When you perform with a regular saving plan, like, okay, during market downturn, I think most of the investor, you will stop the RSP, right? Most of the people will stop the RSP because they see the market went down. But my advice to you is, when market downturn, is the best time to buy into the ETF, especially like the bond market ETF, S&P 500. So what you should do is, instead of cancel off the ETF, cancel off the RSP, you should increase your RSP amount. This is my take. If I invest 500 per month, so if market downturn, I should increase the amount from 500 to 1,000 so that I'm able to buy more during the market crash. Okay,
All right.
last tip. Thank you.
Thank you, Sean. Thank you, everybody. And thanks for the session today.